Welcome students to another lecture in the series. In this video lecture, we will continue with our unit 2, the second head, income from house property. We are about to begin this head in this lecture. Let us get the introduction first of all, that what this income from house property is all about. See, house property can be called to any building or any land in association with that building. For that we use the term here. You may see that house property consists of any building or the land appurtenant thereto, of which the assessee is the owner. It is mandatory that the assessee should be the owner of that particular property. And in this case, the buildings include residential buildings, whether self-occupied or let out for any purpose. It may have office building, factory building, go down, flats, etc. As long as they are not used for business and profession by the owner himself. Appurtenant lands may be in the form of approach lands to and from the public streets, motor garage, courtyard, or compound forming the part of the building. But such land is to be distinguished from a separate open plot of land, so which is not charged under this head, but under the head income from other sources or the income from business or profession, as the case may be. Means if it is a separate plot or something, then it cannot be charged under this particular head. Then further, if I move, let us see the further provisions. If the tenant sublets the house property, the rent received by him from the subtenancy in respect of that particular house property shall be charged under this head only from other sources, but not under this income from house property, or it may be even charged under income from business and profession. The situation of property is immaterial here because it may be situated in India or abroad, it may be anywhere. So let us see an example here. Mr. A has a house. It includes vast open area within the boundaries, and this house has been let out at a rent of rupees 1 lakh rupees per month, out of which the rent of 25,000 per month is attributable to the open land. So in this case, the entire rental income is taxable under the head house property. Okay. Then further, now let us see the basis of charge. They are being defined in section 22 of the Act. Let us see the basis on which we charge this one. I hope till now you have got the idea that income from house property is the income that a person obtains as rent from any house property which is owned by that particular assessee. Section 22 gives you the idea about it further. The annual charge of a property consisting of any buildings or lands appurtenant thereto, of which the assessee is the owner, other than such portions of the property as he may occupy for the purpose of business or profession carried on by him, the profits of which are chargeable to income tax, shall be chargeable to income tax under this head, income from house property. Means that owner is not supposed to sorry owner is not supposed to use that particular land for his own business or profession. In that case, it will not be charged under this particular head. So thus the annual value of a property is taxable under this head if all these conditions are satisfied. The first condition, the property should consist of any building or maybe any land which is in association or in that same compound or the boundary. Assessee should be the owner of the property. This is a mandate. And then the third, the property should not be used by the owner for the purpose of business or profession carried on by him, of which the profits are being generated and they are chargeable to income tax. So in that case, he is not allowed to show that particular income as income from house property. Unless all these aforesaid conditions are satisfied, the property income cannot be charged under this particular head. It will either go to income from other sources or it will be charged under as income from business and profession, as the case may be. Then further, we need to define that what is the deemed ownership, that who is called to be the owner of the property. So in that case, there sometimes it may not be directly owned by the person, but he is considered as deemed to be the owner of that property, although they may not be the legal owners. And this is being defined in section 27. Under this, the first point that we need to study is that transfer to a spouse or to a minor child, the child below 18 years of age. So if the individual transfers any house property to his or her spouse or minor child without any adequate consideration, because in that case the person may not charge any money from his wife or his children, the transferor in that case is deemed to be the owner of that house property so transferred. However, This would not cover cases where property is transferred to a spouse or to a minor married daughter in connection with an agreement to live apart. Means if the person, maybe the husband or wife, they decide to live apart, to get divorced, and in agreement of living apart, if they are giving that particular house, then it is not considered. Then comes holder of an impartible estate. Impartible estate, as the name is suggesting, that you cannot divide that particular estate into different parts. So if the holder of an impartible estate shall be deemed to be the individual owner of all the properties which are being comprised in that estate. The estate, the impartible estate, as the word itself is suggesting, I just informed that it is a property which is not legally divisible, means you cannot divide that particular property. Then further, it can be a member of a cooperative society, or a company or the association of persons to whom a building is allotted or leased under the house building scheme. He would be deemed to be the owner of that particular building if it is allotted to him. Although the cooperative society, company, association remains to be the legal owner of that building, but as that particular flat is being allotted by that particular society to its members who enjoy that particular flat, so technically the cooperative society is the owner, but in that situation the allottee to whom that particular flat or the piece of land is being allotted is deemed to be the owner, and he is supposed to pay the tax on that particular land. Then fourth point here, that person is in possession of a property, like may not be the legal owner, but if he is possessing that particular property. This kind of problem is there in the whole of the country. Actually, there are many cases which are pending. So the person who acquire a house without any registration in the part performance of a contract under section 53A of Transfer of Property Act 1882, in that case he is deemed to be the owner of the house property, although the property may not be registered on his name, but he is considered to be the owner of that property, and if he is earning any income from that property, then he is only liable to pay tax on that particular property under this head, income from house property. Then fifth, the person having the right in a property for a period not less than 12 years. The lessee of a building is deemed to be the owner if the building is leased out to him for a period of 12 years or more. Then further, in this lecture, we need to see how to compute the national net annual value, NAV, of the house property. For that, we need to understand certain terms. The measure of charging income tax under this head is the annual value of the property, that is the inherent capacity of a building to yield the income. The expression annual value is defined in section 23 of the Income Tax Act. In order to determine the annual value or the net annual value, we need to understand few terms. First is expected rent. Expected rent is the money or the amount of money, sum for which the property might be reasonably expected to be let out from year to year. So it can be said to be the most likely rent for that particular house property. Then comes your municipal value. It is the value which is determined by the municipal authorities for the purpose of levying the municipal taxes on that particular house property. Then comes fair rent. It is the amount which is which a similar property of that kind would be fetching in that particular same area or the locality if it is being let out for a year. Then further, we need to understand what is standard rent. It is the sum which is fixed under the Rent Control Act. When the property is subject to this act, the expected rent cannot be higher than the standard rent which is fixed under this act. Then is the actual rent. This is the amount of rent which is received or receivable for a let out period. Then we have municipal taxes. These are the service taxes, basically fire tax, water tax, etc., which is levied by any municipality or the local authority in which the area to which it belongs. So deduction in respect of municipal taxes is helpful in determining the annual value of the house property, and it will be allowed only if these conditions are being met. Means we can subtract the amount of municipal taxes if these conditions are met. First, that the property is let out during the whole year or any part of the previous year. Means you cannot deduct these taxes if that house is self-occupied or if it is not being let out. So it is mandatory to let it out either for the whole year or any part of the year. Then further, that these taxes must be borne by the landlord himself, and if it is being borne by the tenant, then no such deduction can be given. Then comes municipal taxes, must be paid during that particular year only. So where the municipal tax have become due, but have not been actually paid, these will not be deductible in that case. And in a situation if the municipal taxes may be claimed on some payment basis, that is only the year in which they are being paid, even if the taxes belong to a different year. Means suppose for the last year you didn't pay the municipal taxes and you're paying them in this current year. So in this current year only you will be showing them in the books of accounts and will be charging them to the tax. Then comes composite rent. This is a very important point that you need to remember. When the owner of a building gets along with the rent of the building some rent or hire of the other assets, like maybe some furniture or some other different services which is provided in the building, or charge for the security, lift, air conditioning, electricity, water, etc. The total amount so received is called as composite rent together. Means the rent of that particular building and the rent or the charge that you are asking for the furniture or any other services that are being provided along with that house. Like suppose if you are taking a flat in an apartment, in that case you are using the security, lifts, central air conditioning if it is there, electricity services, water services, firefighting services, many other such services. So it's called as composite rent. So the tax treatment of composite rent, here we keep it in two parts. First, if the rent of these two things like your house and the other services, if it is separable, then it is okay, then you can charge it to income tax under this head only. But if it is inseparable, means you cannot calculate the tax separately, the amount separately, that what is the rent of that particular building or flat and what is the amount which is being charged for the other services which are being provided with that particular building or flat, then in that case it is not charged under this head. It will be charged either under income from other sources or from the head profits and gains from business and profession. This is the case when they are not separable. Okay, let us see what is here. When composite rent is inseparable, that is the other party will not accept the letting of one without the other, then such income is taxable as income from profit and gains of business or profession or income from other sources. But when the composite rent is separable, means you can separate it, in that case the rent of the building is taxable as income from house property, and the other charges, the rent and hire for the other assets and charges for different services, is taxable under income from other sources or the head profits and gains from business and profession only. Then net annual value can be computed using these steps. First step, first of all, we will determine the gross annual value of the property using the different concepts that we have studied. Then at step 2, we will minus or deduct the municipal taxes that have been actually paid by the owner during the previous year from that gross annual value, and we can obtain the NAV, that is net annual value, from there. For this video lecture, I am stopping here only. If you have any doubts, please write to me. Bye, take care, study well.